So what we're going to work on today is we're going to describe Canada's monetary policy objective and the framework for setting and achieving it, how the Bank of Canada makes its interest rate decision, achieves its interest rate target. So we've covered a bit of this in the past, but we're going to go deeper into it today. So explain the transmission channels through which the Bank of Canada influences real GDP, jobs, and inflation, and explain how monetary policy and macroprudential regulation seek to prevent financial crises. So the Bank of Canada is the driving force behind Canada's monetary policy. So it's been around since 1935, and the principal role is to promote the economic and financial welfare of Canada. So but the real role they have, the main focus they have is keeping inflation at 2%. So that's really their main focus. Yeah, so that's really their main focus out of anything. So it's fully government owned, and all of the people that are part of the Bank of Canada are selected by the Canadian government. So the current governor of the Bank of Canada is Tiff Macklem, and the former one was Stephen Poloz. The one before was Mark Carney, and Mark Carney he became the Bank of England governor after. But yeah, they've had a lot of very good governors. So yeah, so the Bank of Canada, they perform 4 basic functions. It manages the money supply, conducts monetary policy by controlling the amount of money circulating in the economy. So they do this through buying government bonds to increase the money supply. So that's what they do, and this therefore reduces interest rates. And then they sell government bonds to decrease the money supply, and this increases interest rates. And this is what they did. They did this 2022 to present to bring down inflation. Decreasing the money supply and increasing interest rates brings down inflation. So that's what they did in 2022 to present. So I'm going to just send this to everybody here. And then buying government bonds to increase the money supply. They do this in the short term to grow the economy. So that's what they do in the short term to grow the economy. And then the Bank of Canada not only issues paper currency, but it affects these activities of charter banks and similar financial institutions. So yeah, it varies the supply of money and interest rates. And then also, in this case, through the Bank of Canada managing money supply, they do this to reduce inflation, to preserve the purchasing power of the dollar. So with that, they keeping inflation low will keep the dollar at a price, like keep the dollar at a stable purchasing power. So like if the inflation goes up by extraordinary amounts, like in Zimbabwe, the currency becomes worthless. So like once it's going up by so in Zimbabwe had inflation in trillions of percent. And this made their currency worthless. Now they only use the US dollar and not the Zimbabwe currency, because the Zimbabwe currency is worthless. So like, just so Zimbabwe printed basically on like printed hundreds of trillions of dollars, hundreds of trillions of their currency, and this led to extraordinary inflation, and then their currency was worthless, destroyed their monetary system. So that's why they just don't print like trillions of dollars at once. So that's why they don't. So put that in the chat. So, and then maintaining real output as close as possible to its potential level. So they do that. They want to keep output as close as possible to its potential level. So it doesn't go too far. So like, we don't want real output to be much higher or lower than potential output, because if it is too high, there is an inflationary gap with too much inflation and unaffordability. And then also, if there's too little, if it is too little, there is a recessionary gap with too few jobs and low economic growth and negative economic growth. So that's very important. So that's one of the keys to it also. And then regulating the external value of the Canadian dollar and foreign exchange markets. So that's very important for keeping exports and imports at the same level. So we need to keep exports and imports stable. So regulating the external value of the currency is key. So that's important, because if we reduce the value of the currency, exports go up because our goods are cheaper to foreign companies. And then if we increase the value of the currency, exports go down because our goods are more expensive to foreign companies. So that's why regulating the external value of the Canadian dollar and foreign exchange markets is important, because we want to keep exports high, because having exports is good for our economy, because exports increase economic growth. More exports increase economic growth. So that's one of the reasons why we want to keep the exports high and not have it go down a lot. But also the caveat to that is having a high currency value is beneficial for allowing for more imports. So we can afford more products from other countries. So this is very important for our outsourcing. So once, let's say, I order a lot from AliExpress. So if you order a lot from AliExpress, having a high currency value is important for you to get the lowest price for your AliExpress items. So like if our currency dropped substantially in value, like in Zimbabwe, our AliExpress items would be much more expensive. So this is so the Bank of Canada regulates all of this because it's so, like, if we didn't have the Bank of Canada keeping the currency in check, a lot of the Zimbabwe case could happen. So the Bank of Canada is focused on preventing a Zimbabwe type hyperinflation scenario. Yeah, because what happened in Zimbabwe was just so catastrophic. So preventing that is very important. And also, the Bank of Canada acts as the banker's bank. So holds deposits of the members of the Canadian Payments Association, makes advances to CPA members of the bank rate. So I know I introduced this before, but yeah, like to go deeper into it, to go more into depth into this, the banking system. So the banking system is focused on us making deposits to each member bank, like if it's Bank of Montreal, CIBC, TD, RBC, Bank of Nova Scotia Bank, National Bank, Equitable Bank, Laurentian Bank, and others. And the bank lends out these deposits in the form of mortgages, business loans, commercial loans, and other loans. And the bank receives interest from these loans and makes that, and that is their profit. Then they pay us very little interest on our deposits from this loan interest. So they do that, and then they take the rest of the interest for their profit. So, but the caveat here is that the bank doesn't have our money. Our money is being lent out. So if we want to withdraw our money, we need to, like, the bank needs to borrow from other banks the withdrawal money. If the other banks don't have it, our bank has to ask the Bank of Canada for a loan to cover our withdrawals. And then so the Bank of Canada may have this money in reserves, or they may have to print it and lend it to our banks to allow us to withdraw our money. So that's the banking system. That's banking system in a paragraph or less, basically. So that's how the whole banking system works. But then so in this case, this all breaks down so this whole thing breaks down if there's a bank run. So so if there's a bank run, that's when everyone wants to withdraw their money from the bank. But like I said before, the bank doesn't have our money. Our money is all lent out in loans. So they scramble for finding money from other banks or the Bank of Canada to fulfill all withdrawals. However, the other banks don't have enough money to loan to our bank, and the Bank of Canada cannot just print 20 trillion, like, say 2 trillion. It's like estimated value of all savings in Canada. So like say like potential estimated value of all savings in Canada, and ensure that all of our withdrawals are made. So like they cannot just print this sum of money and loan it to the banks for withdrawal money. So this is when the banks just all fall apart, because they cannot just get all of the money back from mortgage loans and other loans, because so like they just can't get all the money back from all these loans quickly. So bank runs just destroy the system. So bank runs happen because of panic. So bank runs happen through national panic. So like during the 2008 financial crisis, bank runs happened with US banks such as Lehman Brothers and others that were going bankrupt. So the government prevents bank runs through deposit insurance. So in Canada, the CDIC insures up to $100,000 per bank account in Canada. So like if, let's say the bank, so if your bank goes bankrupt, up to $100,000 of your deposits will be insured if the CDIC, if your bank is CDIC insured. So like check, so check if your bank is CDIC insured, just to know that up to $100,000 of your deposits are insured by the government. So in this case, the problem with this is that the government doesn't insure anything above $100,000. So if you had, let's say, 10 million in your account, only 100,000 of that is insured. And the rest could disappear if the bank goes bankrupt. That is the risk of this. So make sure your bank is unlikely to go bankrupt. So that's important. So that's very important to know that, like, if the bank went bankrupt, you would get, let's say, $100,000 of your deposits. But if, let's say, you had more than that in your account, it would evaporate basically. So just be careful with that. Yeah, just make sure you're with a bank that is unlikely to go bankrupt. So do your research and like know how the bank's doing. Yeah, just know how the bank's doing, and then just be careful if, when another crisis comes around, that you won't lose all your money. So I'll just send this over. Go. So the Bank of Canada also acts as the federal government's fiscal agent. So it holds some of the government's bank deposits, it clears the government's checks, it handles the financing of the government's debt by issuing bonds. So they issue bonds. So when the government has a deficit, which they will probably have until like they probably will have a deficit for each year forever, basically. So they issue Canada savings bonds and treasury bills to pay off to finance their deficit. So this is basically, so another word for this is they borrow to cover government programs. So what happens with a deficit is that government spending is greater than tax revenue. So the government needs to pay for the rest of the spending through Canada savings bonds and treasury bills. So that's just what happens with that. So they do this constantly, and the government honestly will not get a deficit for a very long time. And the US government's the same way. They'll always be in deficit, basically. So the Bank of Canada performs 4 basic functions. One of the things is it supervises operations of financial markets to ensure their stability. So that's very important here. So Office of the Superintendent of Financial Institutions, they regulate the banking system in Canada. I actually have a friend who works for the Office of the Superintendent of Financial Institutions, and they keep the banking system regulated in Canada. So that's a benefit, that's very important. Then the Bank of Canada, they set interest rates to control the money supply. Department of Finance is focused on government spending, taxes, etc. So this organization, they regulate the banking system. And then Bank of Canada set interest rates and money supply. Department of Finance, government spending, taxes. And then CDIC ensures deposits. And then Financial Consumer Agency of Canada protects consumers from financial company issues. So they all do very important roles for that. And the Bank of Canada works in conjunction with the Office of Superintendent of Financial Institutions and ensures that they follow global guidelines on banking supervision. And Canada's been effective in supervising the banks because our banks were stable during the 2008 financial crisis, while the US banks were in very rough shape. So yeah, so I'll send this to everybody here. And the monetary policy objectives. The objective of monetary policy is ultimately political. So the Bank of Canada, their focus is to keep inflation low, stable, and predictable. So that's important to keep spending and investment decisions with more confidence, encourages long-term investment in Canada's economy, and contributes to sustained job creation and greater productivity. This improves standard of living. So this objective is key to keeping, this keeps economic growth stable, economic growth and prices stable. So we need that to keep our economy stable. And the monetary policy objectives, they stem from the mandate for the Bank of Canada, from the Bank of Canada Act 1935. So the Bank of Canada is focused on controlling quantity of money and interest rates in order to avoid inflation and, when possible, prevent excessive swings in real GDP growth and unemployment. So the monetary policy objective and framework. Inflation control target. It was adopted in 1991 and has been renewed several times since. So most recently in October 2016 for the 5 years to the end of 2021. The target is aimed to keep inflation at 2% and within a target range of 1 to 3%. So based on this, they've been pretty effective since they set the target in 1991. They've been pretty effective in keeping it low. So yeah, since they set the target of 2% and a range of 1 to 3%, inflation has been around that range. It hasn't been perfect, but it has been pretty consistent. So you see that band here, like it's pretty consistent here. So if you look at that, it's between, so it went negative around 2010 here, but the highest it ever got in this period was about 6%. But yeah, it was mostly between a band of 0 and 4%, roughly. This was before the 2022 high inflation. But yeah, since 1991, the inflation has been mostly between 0 to 4% for the most part. So the inflation targeting has been effective. So this has been effective policy for the Bank of Canada during this period. So the target, the CPI, the inflation target is a very good policy in terms of keeping everything stable. And then here, the bank raises or lowers its policy rate as appropriate in order to achieve the target within a horizon of 6 to 8 quarters. So they changed the target rate. So lately they've been increasing the target rate just to bring down inflation, but it's starting to stop. They're starting to stop the raising of the interest rate because they have been stopping increases of the interest rate because it has been bad for the stock market. housing market and a lot of economic growth cases. So they and also inflation has not been going up as much of late, so they don't need to raise the interest rate as much. So that's why they've kind of kept the interest rate constant lately. They haven't been raising it that much because inflation has been more stable lately. So the inflation control target uses the CPI as the measure of inflation. So the bank has agreed to keep the trend CPI inflation rate at a target of 2% per year. So the problem is you can use core inflation or CPI inflation so core inflation and CPI inflation are different. They include different product prices. So it causes an issue because both inflation numbers would be different. Both don't capture the same products. So that can create an issue there. Here. So there can be a lot of biases in that because there can be certain products that are going up. Yeah, there can be certain products that go up in price that are not included. And this causes an issue because the Bank of Canada may not be seeing a lot of unaffordability that is happening. So like let's say like if gas prices were not included and gas went from $1.30 a liter to $2 a liter, the inflation rate would not be factoring in this massive increase in gas prices. So that would mean that the inflation rate would not be a good measure of affordability if they didn't include gas prices. So like that can be a big issue, and like frequently inflation rates are significantly lower than they should be because certain products are not included. So that's a big issue with inflation here. And the Bank of Canada believes that core inflation is a better measure of the underlying inflation trend and better predicts CPI inflation. So that's good that they use both measures because it's good to use different measures because certain measures leave out certain things and other measures add in certain things. So that's very important there. So Bank of Canada's preferred measures of core inflation. So CPI trim, to calculate CPI trim, components are ranked by monthly inflation rates and CPI basket weights. So they account for 20% lowest and 20% highest inflation rates are excluded. So it's an average of the monthly inflation rates of the components that account for the remaining 60% of the basket weights in the middle distribution. So it adjusts for a lot of things here. So the problem with this measure is that it doesn't include gas prices. So gas prices are excluded. So like in this case, gas prices are excluded, which is bad because if gas prices double, this inflation rate this CPI trim inflation rate would not be a good measure. And also excluding, and then excluding food. Food is excluded, which is bad because groceries are going up, have been going up by a lot in the past 12 months. So like this is probably this is not a good measure because it excludes clothing. So like you shouldn't exclude, so gas prices, food, and clothing are excluded. And these are basic necessities. And the CPI trim rate would be underrepresenting inflation. So that becomes an issue. So this rate would be very very low compared to what it should be. So this one's got a lot of flaws to it. So I'll put this into the chat so everyone can have it. So CPI trim rate is not a good measure. CPI median, however, it includes, so it represents all of the components. So this would be a significantly better measure here. So in this case, it would include all of the components here. So it would so in this CPI median would be a better measure in this case, because yeah, gas prices, food, housing, furniture, driving, clothing, all would be included. CPI common would predict the value obtained by linear regression of the year-over-year change in all items at CPI. So yeah, so it would probably be a good idea to compare the CPI common, CPI median. CPI common and CPI median should be compared to determine what prices, what change in prices has happened. So that would be a good strategy in terms of determining how how prices are changing. So I'll put that there, and then I'll put this here too. So yeah, those would be two good measures to compare. And the monetary policy objective and framework. So this is the target range. So it's 2% with a range of 1 to 3%. And the average of the three core inflation rates has never left the target range. So yeah, if they average the CPI common, CPI median, and CPI trim, it would never leave the target range here. In this time range, but we're not including 2022 here. So 2022 is not included. So 2022 is not included. However, the average of the three core inflation rates would go above the 3% in 2022. That would be the only change that it would break the maximum of 3% here in 2022 if that was included. So the Bank of Canada has been doing a good job of holding inflation close to 2% target until now. Like in 2022, they couldn't keep it within this range. So here, if you look at the comparison of the CPI trim and total CPI, CPI median and CPI common, there's definitely a there is definitely a range between. So it seems like the total CPI in this case, it would have the highest measure, and then it would just go down from there. So based on the total CPI, just seems like it would incorporate more. So the total CPI in this case would incorporate more goods into the basket than CPI trim, CPI median, and CPI common. So that would be, more prices, like more product prices are put into the total CPI. And it is a more comprehensive measure in this case. So yeah, total CPI seems more reliable in this case than the rest, but doing an average of all of them. So if you averaged out, so averaging out total CPI, CPI trim, CPI median, and CPI common. So like adding all of them together and dividing by 4, you will likely get the best measure of inflation in terms of adjusting. So that would be a good way to just adjust for everything. So I'll put that in here. But yeah, this PowerPoint is available under March 2nd, course materials under Fanshawe Online. So as you can see here, the rates have been mostly within the 1% to 3% target range. They haven't really jumped higher or lower compared to the target range, except for certain cases like the 2008 financial crisis with total CPI. This here, the tech bubble burst. This would be also so here this was due to the recovery from the 2008 financial crisis. So that's the recovery, and then here would be the 2008 recession, and then here was likely due to recovery from the 2000 recession, and then this was likely due to the tech bubble burst 2000, when tech stocks, so like when the tech bubble was growing in 2000, when everyone was buying technology stocks. So that's likely why those spikes happened. And then here, this was likely due to this was definitely due to the COVID-19 pandemic recession, 2000. And then this was due to the recovery, COVID-19 recovery, 2025. So yeah, that's likely why these spikes and troughs happened. So I'll send this to everyone here. So send this over. So yeah, that's likely due to, those are the likely causes of these spikes and drops. So then United States, it's likely the same here. Like if you look at the United States and you just overlap the arrows, a lot of it is pretty similar. It's not exactly the same, but it's pretty close. So if you overlap those arrows on here, it's pretty close. So I'll put this on here too. So then the conduct of monetary policy. So how does the Bank of Canada conduct monetary policy? So what is the Bank of Canada's monetary policy instrument? How does the Bank of Canada make its monetary policy decision? So we'll ask the class this. So what is the Bank of Canada's monetary policy instrument? Does Alexandra want to try this one?
I think that the main instrument will be controlling the currency flow. So either increasing or decreasing the currency supply in the country and the use.
Yes, that's great. Perfect. Great job, Alexandra. So yeah, increasing or decreasing the currency supply, and that's basically the same as increasing, decreasing, or increasing the interest rate. Great job. Excellent. And then here, how does the Bank of Canada make its policy decision? Does Ashley want to try?
Sure. Would that be based on the inflation rates? Like that's one of the tools they use to make their
Yes.
decision. Yeah.
Yeah, exactly. So officially, they make their policy decision based on the current inflation rate. So yeah, officially they do that. So yeah, great job on that. And then how does the bank implement its policy? Does Didier want to try this one?
Would it be by telling other banks what to do?
Yeah, that's one of the ways they do it. Yeah, that's great. So they can there's a few ways they can do this through to reduce the money supply. The bank can tell other banks to increase the reserves they hold at the Bank of Canada. So that's something they can do. Also, through raising the reserve requirement. Also, they can raise interest rates. They can sell government bonds. Yeah, so there's a few different ways they can implement their policy. It's usually through reserve ratios, increasing reserve requirements, raising interest rates, or selling government bonds. So yeah, good job, Didier. That was excellent. And then yeah, I'll send this over from the chat to everybody. And then the conduct of monetary policy. The monetary policy instrument. So the monetary policy instrument is a variable that the Bank of Canada can directly control, closely target. So the Bank of Canada has three possible instruments: the quantity of money, the monetary base, the price of the Canadian money on the foreign exchange market, the exchange rate, and the opportunity cost of holding money, the short-term interest rate. So I missed one of them. So they can change the exchange rate. So in that case, if they increase the value, of the currency, that means that the money supply decrease, because the value of the currency is based on how rare it is. So that's what they would do with that. And also to add on, number 4 would be changing reserve requirements. So increase reserve requirements to increase No, to reduce the money supply. And yeah, so they would increase reserve requirements to reduce the money supply. So that's what they can do. They can change the quantity of money, the money supply. They can change the price of the Canadian money on the foreign exchange market, exchange rate. Also, they can change the opportunity cost of holding money, the short-term interest rate. So those are the things they can do. And also they can change reserve requirements, increase reserve requirements to reduce money supply. So those are the 4 things they can do. So the Bank of Canada can set any one of these 4 variables, but it cannot set all 3. So the values of 2 of them are the consequence of the value at which the 3rd one is set. So if the Bank of Canada decreases the quantity of money, both the interest rate and the exchange rate would rise. So that's just what would happen. So yeah, so and also if they increase the quantity of money, the interest rate would go down and the exchange rate would go down. So yeah, if you do 1, other 2 will change in that case. So that's just that's what would happen here. And also I'll go through some other scenarios for this. So if the interest rate goes up, the money supply will go down and the exchange rate will go up. And also, if the interest rate goes down, the money supply will go up and the exchange rate would go down. And then also, if the exchange rate, so we'll just go through these scenarios here. So those 4, this one, this one, this one, this one, those are the ones that yeah, so just remember those ones. So I'll put this in the chat here. So remember, if the bank decreased the quantity of money, both the interest rate and exchange rate would rise. If they increase the quantity of money, the interest rate would go down, the exchange rate would go down. If the interest rate goes up, the money supply will go down, the exchange rate will go up. The interest rate goes down, the money supply will go up, and the exchange rate will go down. So yeah, so I put that in the chat. And also, if they increase the value of the currency, that means the money supply decreased because the value of the currency is based on how rare it is. So rareness is key to the value of the currency. So rareness is key to the value of the currency. So that's integral to the value of the currency. So that's really what keeps its value. If it's rare, that's really what keeps its value. So then chat. So interest rates, exchange rate, and the balance of payments, changes in interest rates, increasing a country's interest rate causes capital inflow, appreciates a country's currency. And then, so that means that so if the interest rate goes up, foreign investors will want to invest in your country because they will get a higher rate of return due to the higher interest rate. And this would increase the value of the currency. And then if the interest rate goes down, foreign investors will not want to invest in your country as much because they will have a lower rate of return due to the lower interest rate. And this would reduce the value of the currency. The movement of capital causes exchange rates, and interest rate volatility is exchange rate volatility. So yeah, so in that case, so when they say interest rate volatility is equal to exchange rate volatility, that means that if the interest rate is changing by a lot constantly, the exchange rate will change a lot constantly. So like example, Zimbabwe, their interest rate went down massively, and this caused their currency to go down massively. So yeah, so if there's a lot of change in interest rates, there's gonna be a lot of change in exchange rates. So that's very important to know there. When the Bank of Canada raised its interest rate, the quantity of money would decrease and the exchange rate would rise. And then if the Bank of Canada lowered the exchange rate, the quantity of money would increase and the interest rate would fall. So so that's what they did in, so this is what they did in with fixed exchange rates. This is what they do with fixed exchange rates. Canada has a floating exchange rate. And Canada would not change the exchange rate. Canada only changes the money supply and the interest rate, not the exchange rate, because we are in a floating exchange rate country. If you are in a fixed exchange rate country, your government / central bank will change the exchange rate, interest rate, and money supply. If you are in a floating exchange rate country, your government will not change the exchange rate, but the government will still change the interest rate and money supply. Yeah. So that's the difference between a floating and fixed there. Yeah. So we're floating in Canada. The overnight loans rate, it's the same, it's basically the same thing as the interest rate. And that's the rate that banks charge each other for lending to each other. So like every business day, Canada's financial institutions move money back and forth among themselves for their customers. Whenever you use your debit card or send an e-transfer, money flows between financial institutions. At the end of each day, they need to settle all these payments. Some institutions may have sent out more in payments than received, while others may have received more than they sent. To get back to balance, financial institutions can borrow money from each other for one day in the overnight market. Banks sets a target for the interest rate. We want financial institutions to charge each other when they make these overnight loans. So that's what they charge for lending to each other. So the overnight loans rate, it's basically the same thing as the interest rate. So if the Bank of Canada changes the interest rate, the overnight loan rate changes in the same way. So it's basically the same thing. When inflation is low, the government wants to, and the bank wants to avoid recession, it lowers the overnight loans rate. In that case, so they keep it low to avoid recession, and low is best for our stock markets. So a low interest rate is best for stock markets. So low interest rate is best for our stock markets and housing markets. So like, yeah, best time to buy stock is in low interest rate environment. And also you get the lowest borrowing costs for mortgages in a low interest rate environment. And then here, the Bank of Canada only changes the interest rate by about a quarter of a percentage point when they change it, because it's too much to change it by a full percentage point. And they set it through open market operations. So they do this through buying and selling of government bonds, like I talked about before. So open market operations is when that means that they buy and sell government bonds to change the interest rate. So that's what open market operations is in that case. And then, so to make the interest rate decision, the bank kind of gathers data about the economy, the way it responds to shocks, and the way it responds to policy. So processes the data and figures out what the best level is for the interest rate. So this is the schedule for 2022 that they had. So usually they make an announcement for the interest rate every few months. So in this case, January, April. So in this case, January, March, April, June, July, September, October, December. So it's usually every 1 or 2 months. In this case, they did it about 1, 2, 3, 4, 5, 6, 7, 8 times in 2022. And then after announcing an interest rate decision, the bank engages in a public communication to explain the reason for decision. So targeting the overnight rate, hitting the overnight loans rate target. Once the interest rate decision is made, the Bank of Canada achieves its target by using 2 tools. Operating bands. So like the operating band is the banker's deposit rate is at the bottom. The target for the overnight rate is here, and the bank rate is here. So it's usually the one that the Bank of Canada uses is between 1 to 3%. So 1% in that case would be the banker's deposit rate. 2% would be the target for the overnight rate. And then 3% is the bank rate. So that's what they do. That's the band that they use. The 1 to 3% band would be similar to this. Yeah, so that's how they set it, because they want to have it between 1 to 3%. And that's what it would be. So like I said before, the reserve rate will change the interest rate. So in this case, the overnight loans rate cannot exceed the bank rate. So if it did, the bank could make a profit by borrowing for the Bank of Canada and lending to another bank. So that's why it's set like that, where the bank rate's the highest, the overnight loan rate is the middle, and settlement balance rate is bottom. But all banks can borrow from the Bank of Canada the bank rate, so no bank is willing to pay more than the bank rate to borrow reserves. So the overnight loans rate cannot fall below the settlement balances rate. So that's very important. That's why we have that band. So the bank rate's at the top, the overnight loans rate is the middle, settlement balances rate is at the bottom. So that's why we have the band set up like this, just to prevent any sort of issue with making a profit by borrowing from another bank and increasing its reserves at the Bank of Canada. So this is what happens over time. There's always a margin between the bank rate, the overnight lending rate, and the overnight target rate. So the bank rate is always highest in this case, and that's how it should be. So the bank rate should always be highest. And as you see here, it is over this period. So the bank rate can't be below any of the other rates. The bank rate should always be the highest. And then here's another graph showing that, and it shows that the bank rate is always highest also. So here it is. So the Bank of Canada's goal is to keep inflation as close as 2% per year. When the Bank of Canada uses its policy tools to move the overnight rate closer to its desired level, a series of events occurs. So we're going to talk about the events that happen when this changes. So when the Bank of Canada lowers the overnight loans rate, the bank buys securities in an open market operation. So they buy securities. So when they say securities, they mean government bonds. So here, so securities, it's government bonds. And then other short-term interest rates and exchange rate fall. So they all fall together. And then the quantity of money and the supply of loanable funds increase. So that's what happens. And then the long-term real interest rate falls. Consumption, expenditure, investments, and net exports increase. And then aggregate demand increases. So real GDP growth and inflation rate increase. So then when the Bank of Canada raises the overnight loans rate, the ripple effects go in the opposite direction. So that's just the step-by-step process on what happens. So I'll send this to everybody here. So then there's a flow chart here in terms of showing what happens. So let's say for raising the interest rate. So when the Bank of Canada raises the overnight loans rate target, the bank sells securities in open market operation. Other short-term interest rates rise and the exchange rate rises. The quantity of money and supply of loanable funds decrease. The long-term real interest rate rises. Consumption, expenditure, and interest in investment and net exports decrease. Aggregate demand decreases. Real GDP growth and the inflation rate decrease. So they all move in unison. So in this case, as the short-term interest bill rate goes down, the long-term bill rate goes down. But it takes a while for it to adjust. So and also the overnight loans rate goes down. So it takes a while for the long-term bill rate to adjust. So there's kind of a gap in the short term. So as you see here, there's a gap between, there is a gap between the long-term bond rate and the overnight loans rate / 3-month treasury bill rate because of lag time. So like it takes a while for the long-term bond rate to adjust to interest rate changes. So there's a lag. So it takes a while for it to adjust. But the short-term bill rate and overnight loans rate move in the exact same direction. They move almost perfectly the same and overlap. So as you can see here, they almost 100% overlap. Look at that. It's an almost perfect correlation. There's very little difference between the short-term bill rate, the 3-month treasury bill rate, and the overnight loans rate. They're is almost 0% difference between the overnight loans rate and the 3-month treasury bill rate. So that's the difference between, yeah, so that's a good showing of the difference between long-term and short-term interest rates. So the long-term needs some time to adjust, while the short-term adjusts already. So short-term interest rates, so short-term interest rates adjust automatically. Long-term interest rates need time, like long-term interest rates adjust after a long time period. Yeah, so that's just what happens with that there. So the 3-month treasury bill rate is the interest paid by the government of Canada on 3-month debt. So it's similar to the interest rate paid by businesses on short-term loans. So notice how closely the 3-month treasury bill rate follows overnight loans rate. The two rates are almost identical. It's because they're both short-term rates. So the overnight loans rate and 3-month treasury bill rate are both short-term interest rates, and they move together because they are short-term. Because they are short-term. So that's why they move together, because they're short-term. And then also a powerful substitution effect keeps these two interest rates close. So charter banks choose where to hold their short-term liquid assets. So an overnight loan to another bank is a close substitute for short-term securities such as treasury bills. So instead of buying a treasury bill, so in this case, instead of buying a treasury bill, the bank can loan to another bank for the same interest rate. So that is one of the reasons why the overnight loans rate is the same as the 3-month treasury bill rate, because buying a treasury bill offers the same interest rate as lending to another bank. So that's one of the reasons too. Also, if the interest rate on treasury bills is greater than the overnight loans rate, people will buy more treasury bills. So yeah, if the interest rate was higher on treasury bills than overnight loans, banks would just buy treasury bills and not lend to other banks. So that's what would happen there. The long-term bond rate is the interest rate paid on bonds issued by large corporations, finance new capital, and influence their investment decisions. Two features of the long-term bond rate stand out. So they're higher than short-term rates and fluctuate less than short-term rates. So it is higher than two short-term rates because long-term loans are riskier than short-term loans. Lenders must be compensated for the additional risk. It fluctuates less because it's influenced by the expectations by future short-term and current short-term interest rates. And the alternative to borrowing or lending long-term is borrow or lend using a sequence of short-term securities. So if the long-term rate is greater than the expected average of future short-term rates, people will lend long-term and borrow short-term. because in this case, they'll make more money. So they can borrow at a cheap rates and lend at a higher rate than they borrow. And that makes them profit. So that would lead to the long-term interest rate falling in the long run. And then market forces act to keep them similar plus risk premium. So yeah, then the long-term interest rate will start falling because the short term and the long term should be the same in that case. So yeah, eventually the long-term interest rate will fall eventually. So exchange rate fluctuations. So the exchange rate responds to changes in interest rate in Canada relative to interest rates in other countries. So an increase in the overnight rate attracts capital, so that would appreciate the Canadian dollar. But other factors are also at work, which makes the exchange rate hard to predict. So oil prices, if oil prices go up, the Canadian dollar is likely to go up because the oil companies in Alberta will make more profit through selling oil at a higher price. And this would then lead to higher, so like they would be able to sell oil at a higher price, which would increase Canadian GDP, and this would increase Canadian dollar value. So that's what would happen in that case. Send this over here. And then if the Bank of Canada lowers the overnight loans rate, the quantity of money and the quantity of bank loans increase, consumption investment plans change, long-term real interest rate, equilibrium in the market for low-level funds, term is the long-term real interest rate, which equals nominal interest rate minus expected inflation rate. Long-term real interest rate influences expenditure plans. So then expenditure plans, so a change in the overnight loans rate changes aggregate expenditure plans. So that changes aggregate demand, real GDP, and the price level. So if inflation is low and the output gap is negative, the bank lowers the overnight loans rate target. And this would increase demand in this case. And an increase in reserves increases the supply of money. The short-term interest rate falls and the quantity of money demanded increases. The increase in the supply of money increases the supply of loanable funds. The long-term real interest rate falls and investment increases. The fall in the real interest rate increases aggregate planned expenditure. The multiplier increases aggregate demand. So the Bank of Canada fights inflation. If inflation is too high and the output gap is positive, the Bank of Canada raises the overnight loans rate target. The bank conducts an open market sale to decrease reserves and hit the overnight loans rate target. And a decrease in the supply of money decreases the supply of loanable funds. The long-term real interest rate rises and investment decreases. The decrease in the supply of money decreases the supply of loanable funds. The long-term real interest rate rises and investment decreases. The rise in real interest rates decreases aggregate planned expenditure. The multiplier decreases aggregate demand. So summary of the monetary transmission mechanism. An increase in the supply of money will lead to an excess supply of money, a fall in the equilibrium interest rate, an increase in desired investment expenditure, and that would lead to an upward shift in the AE curve and a rightward shift in the AD curve. So don't worry about the AE curve. The AE curve is beyond the scope. Curve is beyond the scope of this course. So don't worry about that here. And then contractionary monetary policy would reduce aggregate demand, and that would close the inflationary gap. So contractionary monetary policy reduces aggregate demand and gets rid of the inflationary gap in this case. Expansionary monetary policy increases aggregate demand to aggregate demand 2, so recessionary gap is closed. So expansionary monetary policy would get rid of the recessionary gap. So in this case, expansionary monetary policy gets rid of the recessionary gap. And real GDP is equal to potential GDP. So yeah, that's that.